markets are going to do to Jay Powell what they did to him in September if the Fed cuts rates in July. And that is that he will cut the Fed funds rate and the 10-year yield will go up rather than down. Because I think clearly the markets right now, just reading the tape, seem to believe that this is not a backdrop against which the Fed really needs to be cutting rates, because they probably believe this sort of narrative that the consumer or the economy broadly is stronger than it is. And there's a handful of pretty decent sized constituent that fears inflation from the tariffs. And then there's the overwhelming majority of people who are concerned about the fiscal situation and the idea that if the economy slows, the deficit's just going to get much, much bigger. And then how are we going to finance that? So it seems to me like we're in an environment where this whole hubbub about the Fed cutting rates is sort of entertainment, because if they cut rates, I don't really see it having a significant impact. I think we're at the point now where it's really going to come back to fiscal to right size the economy if we have a downturn, whether it's a spectacular collapse or the steady grind. And I will say that, I had been in the spectacular collapse camp for a long, long time, and maybe that's going to happen because now this big, beautiful bill makes me think maybe we're going to have to do another stretch of this grind, because now you've got some tax breaks that we didn't have before. We've got the depreciation and CapEx, incentives for capital spending that will help offset or at least delay some of this pain, or let's say extend it out a little bit farther. But you're still going to be competing with it, slowing consumer spending on the back of these credit issues and the desperate efforts to sustain the debt service, which is, I had some charts on that from my missive to clients today that just shows household interest payments, their interest expense. And it's an all-time record high, not surprisingly, but even relative to disposable income, it's getting very extended. So oftentimes you hear people dismiss the interest expense by household saying, yeah, but income's gone up so much that really it's not unmanageable. And it looks like we're really starting to push into territory where it does become problematic, levels that we've seen at prior recessions. So I do think that this consumer slowdown is just going to continue to grind on, notwithstanding the big, beautiful bill, and that eventually people are going to do the math and say, look, there's no end to these $3 trillion deficits in sight. And that's really our issue, is that we're stuck in this environment where long rates really don't have much room to come down, regardless of what happens to the economy, and the deficits aren't going to come down. And how do we navigate that from an investment standpoint? I think that's really the big question. Another data point that just hit the tape a little while ago on consumer credit, which is all of the consumer borrowing that is not mortgages. So it's auto loans, credit card loans, student loans. And what we saw is that credit card borrowing actually declined. And I think it posted its second largest decline since COVID. It's very unusual for credit card borrowing to actually go negative. And obviously, you'll recall that it did that during COVID just because people were getting so much money from the government. They were actually smartly paying down their credit card balance. So, but that's obviously not the case right now. And the student loan payments are resuming. And they actually resumed May 5th. So I think we might be starting to see the impact of those payments on other forms of credit, because as we also talked about, you face wage garnishment if you don't pay your student loans. And in fact, I read one study that suggested that 2 million student loan borrowers are presently facing wage garnishment this summer. And the Department of Education is forecasting that that number will rise to 10 million over the next few months. So this is a huge drag on that part of the consumer. And I think that's why we're seeing credit card borrowing being pulled back and spending, because the credit cards have been the way people have paid for all these, the doodads that they're buying on Amazon. So maybe we're going to see a pullback in the retail sales numbers when they come out. I guess that's next week now. And importantly, it's going to compromise your ability to buy a new home, to qualify for a mortgage. And that obviously, housing is crucial to the economy in general. So that's a huge one. I mean, it's something to talk about consumers buying less stuff on Amazon and, not helping Jeff Bezos pay for his $50 million wedding. But it's something else if they suddenly say, we can't afford to buy that new home, that the knock-on consequences of that obviously are much more significant, the multiplier effect of that on the economy. So I think this student loan thing, and I know we've talked about that before and you've heard it from other people, could be sort of the catalyst for a broader slowdown in the consumer, or let me put it differently, for the recognition that the consumer really hasn't been that strong and that it has strictly been this forbearance and the, ability to kind of go through buy now, pay later and move credit from here to there that's now being compromised, that really kind of pulls the curtain back and people realize the economy really isn't as strong as popularly imagined. And, we face some other headwinds too, like the fact that today, again, we've got 10-year yields back over 440. So I know I'm dancing all over here, but kind of weaving that back to the housing thing. The Atlanta Fed has an interactive housing affordability portal, and it walks you through the affordability index. And right now, I guess housing expenditures take up 46% of the median household budget. And the appropriate threshold, they say, is 30%. If you do the math on that, and assume that home prices don't go anywhere. So let's assume no one goes into negative equity and your home price stays where it is. Mortgage rates would have to go from 6.7% today to 4%. Yeah, it's massive. Rates would have to come down so much, and way more than the markets are presently expecting rates will come down, in order to kind of loosen the vice grip on the housing market. Either that or home prices will have to come down a lot. So, you're looking at two kind of dire alternatives to get that market opened up again. The alternatives right now are uninspiring. Either rates come down because we have this complete collapse in economic activity, and that reflexively sows the seeds of a decline in interest rates, or interest rates stay where they are. And what happens? Do we have to have more big, beautiful bills and actual fiscal stimulus like we had during COVID to support and sustain growth and asset prices at their current levels? In that case, we're talking about a massive decline in the dollar. So whether it's interest rates that are going to have to move or the dollar is going to have to move, one or the other is going to be a real disaster, because I don't see any other way we can worm our way out of this scenario. I think we've been tiptoeing into this for quite a while, and that was what gave rise to this buy now, pay later phenomenon, which just exploded because, there was this idea, the beauty, I think, of the buy now, pay later, in addition to, being able to put, a fraction down on whatever it was that you were trying to buy, these layaway things, is that no one was reporting the data to the credit agencies. So if you fell behind on your buy now, pay later payments, it wasn't hurting you in any way. It wasn't like all of a sudden you weren't going to be able to, they were going to lower your credit limit on your credit card, or it was going to affect you getting a mortgage or anything like that. They are now starting to report that. I think Equifax or TransUnion, a couple of the big credit agencies, are now collecting data on buy now, pay later. So I think that we've been kind of moving in this direction toward debt saturation, where people are just getting more and more desperate. And I think buy now, pay later probably came about after the post-GFC, the Consumer Finance, whatever Bureau, the CFPB,
right, the protection,
tried it to do away with, really clamp down on the payday lending industry. And I think that kind of, as all these things do, kind of opens the door to some new novel way to basically lend money to people who are so distressed that they wouldn't otherwise be able to get access to credit, much the same way that in the corporate market, they are now, instead of banks giving them the money, they're, getting money from
private credit.
So it's kind of the same situation where you can only go by the anecdotes because there is no hard data that is tracking it. But, I talk to people who are in or know people who are in that space, and the stories are just horrifying. There's from companies that are basically just garbage, and they just keep doing all these, they find all these ways to basically subordinate the, new debt, and they're constantly like piling debt on top of debt on top of debt. And you wonder, at what point do the people who were senior, who are now getting junior and getting pushed farther and farther down on the chain, stand up and say, we're not going to take it anymore. But so far, they seem to be able to play these games. But the real sign that we're reaching that point where the jig is up is this push to bring access to retail investors via ETFs. It's like we've got to find some patsy. We've burned through the pensions and the insurers and the endowments, so now we're going to go to retail, and that's pretty much where we are. Obviously, that would be huge because the high end drives all of marginal consumption. But, it seems like this is probably very much related to, let's call it volatility in the stock market, basically since the tariff diplomacy, should we call it that, was unveiled in April. And the market's recovered a lot, but it's still bouncing around. It's kind of, you need a little Pepto-Bismol, and the last couple of days have been challenging as we go back to this idea that we're going to have higher tariffs on some of our important trade partners, and then copper tariffs at 50%, which is obviously a hair-raising number. So I think that a lot of this is kind of an indication of a little bit of a reverse wealth effect, despite the fact that we really haven't seen much of a decline in the net worth of that high-end constituent, which kind of is foreboding when you think about the prospect of what would happen if the market actually did have a serious correction and sustained it, didn't immediately bounce back. That would have a more durable impact on the economy. But at the end of the day, ultimately, it's going to be housing that's going to be so much more impactful because it does affect such a larger swath of consumers and has that real multiplier effect throughout the economy in terms of construction and refurbishing and appliances. There's so many things that happen when you buy a house that just multiply through the economy. So, but to your question on the high end, clearly we're starting to see some signs of slowdown there, but I don't know that we need to see the high end crack to necessarily ratify this consumer recession story. In real terms, retail sales have gone nowhere for 3 or 4 years now. So broadly speaking, the consumer has been in recession, and now maybe the high end is starting to cool it a little bit, but nothing has changed fundamentally in terms of the weakness of the average consumer. I think what we're distinguishing between is the perceptions about the economy on Wall Street versus the perceptions about the economy on Main Street. And Wall Street has been diluted by that higher end that's been sustaining the average statistics that they all look at, their headline scanners, and they see, consumer spending broadly is up, and they don't do the analysis, that some of us are doing that shows that the only thing that's up in consumer spending is insurance, healthcare, food, all the things people can't live without. And when you strip that stuff away, they're actually slowing their spending. So I think it's maybe we're going to start to see this situation where Main Street and Wall Street's perceptions come to meet. And they're not going to meet, in my view, by Main Street's perceptions about the economy improving. It's going to be Wall Street's coming down to the reality that has been the reality for going on 4 years now.